Hello, my name is Nolan Hutter, and this is my strategic knowledge presentation on the company BlackRock. So to start us off, we are going to begin talking about their background a little bit. BlackRock is a multinational investment management company founded in 1988 by Larry Fink. It is based in New York City and has about 19,000 employees today with offices in 36 different countries, 78 total offices worldwide. So they're pretty widespread and pretty large investment management companies. So now we're going to take a little bit better look at the industry. The industry is filled with intense competition. I think that's one of the biggest challenges you face in this industry is dealing with the competition. You got Goldman Sachs, Morgan Stanley, J.P. Morgan Chase, Vanguard, a lot of these big companies that have been around for a long time and probably much longer than BlackRock, only being started in 1988. And just to get an idea in terms of size of the industry, there's over $100 trillion of assets under management in the world today, and that is a large number, and that just shows you the magnitude of what these companies are really doing and how much money that they actually are handling. But there are a lot of external factors that impact these companies, things like current events, trends, and we're going to talk a little bit more about these external factors as we move on into the next slide. So we're going to talk about the forces here. The Porter's five forces model is always a good one to start with, and we're going to say the threat of new entry is very low in this industry, and especially for BlackRock. While they're so big, it's going to be so difficult for a company to be able to come in and they're going to need so much time and resources and capital to be able to get anywhere near the level that they are, and it's really not possible to do that at this point. After BlackRock's become so established at this point that there's not really any threat of new entry. Supplier power, I think the big thing here is just to recognize the diversification in the products that BlackRock has, and that they're not really needing to go out to go seek specific suppliers in order to get their financial products and things such as that. And there's different banks and financial institutions that they may go to for some resources, but realistically, there's such a widespread of those across the country that there's no need to worry about the power of suppliers here either. The big force that's coming into play here is the power of the buyer. So the reason for that is because of this high level of competition with many of these big companies all being kind of in the same region and dealing with similar types of client bases. And what it really comes down to is that these people are going to come in and try to move negotiations in their direction because they want to pay lower fees for those investment products, and the investment managers want their business. And I think that's where it becomes a struggle, because you either have to show that you're going to be giving value that's well beyond other companies, or you're going to have to bring that fee down. So I think BlackRock, with such a high level focus in performance and quality of product, and and the fact that they're globalized and that they have different access to different markets, is a really big impact, because it differentiates them from the rest of the crowd and allows them to keep their fees at a high level. So now I'll move on to threat of substitution. It's not very high here, just because of the expertise and experience levels that you have at a company like BlackRock or any of these big financial advising or not advising and investment manager companies. It's just, you're not going to be able to find a better way to actively manage and invest your money. So there's not, I would say the threat of substitution is very low as well. Competitive rivalry is obviously the biggest one, with all these different companies competing for similar types of clients, and they want the money. They want to drive up that assets under management number. They want to bring in more revenue, more fees for their company. It's all performance based. So, it's a challenge whenever you're dealing with these inside industry rivalries, and especially when you're all in the same neighborhood. A lot of these, New York's the capital of the financial world in terms of investment management. So there's a lot of people right there in New York trying to do the same thing as BlackRock. So how do you differentiate yourself? And then also on top of that, a lot of historical trends play a big impact as forces outside of this Porter Five Forces model. Things like COVID-19, things such as the war in the Ukraine, or even the 2008 housing crisis. Things like this have been giving trials and tribulations to these types of companies forever, and those are big events. But even things such as like lengthening the life expectancy as time has gone on throughout history. That changes the way that they're investing your money, because you're going to need more money if you're living for a longer period of time. You're going to be retiring at the same age, and then you're going to need more money. And that's all based on demographics and different things like that as well. So there's a lot of factors that are external and kind of out of their control that they're constantly adapting to. And really, the companies that you see at the top are the ones that are able to best combat these and yet still find positive returns, even when these different factors are heightening the risk level a little bit. So, it's all about who can adapt in this industry, I would say. The mission statement for BlackRock is to create a better financial future for their clients. So how does this reflect on their leadership, their core values? Well, their core values is that their number one priority is being a fiduciary, which means best serving your client in whatever means necessary. And they also say that they want to do that as one team. So as a company, BlackRock, they're working together. They're trying to, they're pushing their every effort possible into better serving their clients, and they're going to do that together. Another big thing is that they're passionate about performance, it says, and I really like that, because it just shows that, that competitive, that urge to succeed, that separates them and really shows, and I think that really reflects that. I think better future is important too. Sustainable future is what they're looking for, and not even for their clients, or for their company, but even for the world. So a lot of sustainable investment products, meaning like they're working more to invest with companies that are using green methods for operations. They're not releasing big carbon footprints, and they're not releasing pollution. They're not, taking advantage of labor and things like that. So they're, very moral and ethical in terms of the way they're investing, or they're at least moving more in that direction. So we'll move on now to performance. You can see that AUM, assets under management number. I think the reason it's so high, is because you got BlackRock, who is purely an investment manager. They don't have these other streams of revenues coming in as does Charles Schwab, Morgan Stanley, and Goldman Sachs does. They're much more developed. They've been around for a longer time. They have those. You can see their revenue is higher, although their assets under management is lower. That means that they probably have higher fees. They potentially, maybe they work with, maybe they have financial advisory as a big thing that brings in revenue, or maybe they're doing more wealth management, or strictly retirement planning, or financial planning, or insurance, or healthcare, and things like that. Where BlackRock, they're right now currently just strictly an investment manager. And a little bit that too shows in the valuation and their market cap, where they're only at 115 billion in comparison to some of these bigger numbers you're seeing from the other companies. So a couple other ratios I put down were price earnings ratio. That's you can kind of determine. I think that 807 stock price number is a little high right now for BlackRock, with that price earnings ratio being at almost 21 in comparison to the other ones. That means it might be a little bit overvalued there, but I think it's a pretty reasonable number to have, between 20 and 25 for the price earnings ratio. The current ratio is a really good number for BlackRock, as it's, that 3.72 basically means that they are extremely liquid in comparison to their competitors. That basically takes off any burden in paying short-term liabilities or debts that these other companies have their money a little bit more tied up. So their short-term debts are going to come around, and they're going to have a tougher time, liquidating their funds in order to pay them off. And that's going to cause them trouble. But I think for BlackRock, that's a really positive thing to see. The debt equity ratio, that shows that your assets are significantly higher than your debt for BlackRock in comparison to their competitors. While Charles Schwab has a really good number there too at 0.87, but that just means that, they're really, their assets are just way outweighing their debt, and that just means that they're going to be they're so comfortable in the long term, and what they're doing is super sustainable at the level that they're currently doing that. And it's at a really substantial level already, and so it's really impressive to see a number that low, especially in a financial company. So now we're going to look at the SWOT analysis. Strengths are brand reputation, size, globalize, and diversification. They sell a wide range of products, whether that's equities, bonds, retail, multi-asset class investments, ETFs, all these different things, and real estate investments, stuff like that. That's all available to anybody that works with BlackRock. And that wide variety of products is really good, along with the fact that they're also globalized. So you're not just getting access to the American version of that, you're also getting access to all these different markets around the world that, they have a wide range of products in each of those markets. So it's a really wide selection that they allow for you to have there. And I think that's what really drives your brand reputation up, is that and just the overall size, that $9.43 trillion in assets under management is the biggest in the United States right now. Some of the weaknesses: 80% of their assets under management are with institutionalized companies. So it's a little bit hard for. I think right now it's fine, but I think they need to move away and try to diversify their consumer base and maybe just widen their reach. And with a wide variety of products, I think they shouldn't have trouble in being able to, meet the needs of these other people. But I think the institutionalized companies have such large sums of money that I think they're looking more into that at the moment. But I think that's a weakness, I'd say. I think it's just a little bit risky always whenever you're not diversified in any aspect. Opportunities, strategic acquisitions, as I was talking about these other companies who are finding other ways to bring in revenue outside of investment management. I think it's important that they start, seeking out, these credit unions or healthcare or financial advisory companies and acquiring them, and then being able to be experts at, a wider, once again, diversifying their business from just being an investment manager. So I think that would be a really positive move for them to really take that next step to being a global powerhouse company. Passive management strategies, that's stuff like ETFs, most bond funds and indexes, that by focusing on these, I think a lot of people are trying to move in that direction right now with the uncertainties of the market. So I think by, putting more time and pushing those products out, I think would find a lot of success for them, just because of the lack of, with interest rates and being hiked and people are expecting cuts, people really don't know what to think and what to do with their money. So I think a lot of people are trying to just put their money in safe, low growth but low risk investments at the time, which is what you're going to get with passive management strategies. And then you got data analytics and AI, so you can pass off a lot of those monotonous analysis that workers are doing within the company to AI, and they can just complete these for you and allow the people that are working there, who are brilliant people, just to really critically think and come up with ideas and really help push the company forward, rather than sitting there on their computer completing these monotonous tasks. Some of the threats of the SEC regulations, you always got to walk the straight and narrow when you're a big financial company. They're always having an eye out. So you got to be careful not to have any missteps, because that's very damaging to the reputation of a company. And then the volatility risk that you're always facing as a financial, company or investment manager that you're dealing with, just because, whatever happens, you don't really know what's going to happen tomorrow. So it could be anything, whether it's, unemployment rates spike up and the Fed decides to cut rates sooner than they're expecting, or it could be things with, anything like COVID or housing market collapse. Anything can happen. So I think you just always are managing risks and being ready to be adaptable and be able to make changes on the fly. Competitive advantage. So access to global markets, as we talked about, size and brand awareness, reputation, investment technology. Aladdin is something that they use that created a lot of huge impact for them. It really differentiates them. It's one of the best investment products that you can have in order developing these portfolios and building strategies. And that is massive for them. And I think it's really proved that as they've been more successful in their portfolio management than a lot of companies have, especially in these trying times and questionable market environments. So I think that's something they have that's a big part of the value that they bring to the table. We pretty much talked about this already, so we're going to skip over this. Corporate structure, so board of directors are who's going to oversee the long-term strategic goals. Chief executive board is going to go out and push that every single day. Investment managers are building the portfolios. Client relationship managers are, they're dealing with sales, marketing, things of that nature. And then you have your more common employees in the technology, operations, finance, administration. So pretty generic build, but you got Larry Fink still as CEO for this long time, and I think that shows a lot about the company and who they are. Ethical, they got the clients first, fiduciary responsibility, organizational culture with, performance, passion. It's a very good and competitive environment. And as I said, they're pushing those sustainability products. So right now, I think the big thing for them moving forward is they want to grow. I think that utilizing AI and data analytics to help them do that is a very big opportunity. I think a lot of companies are going to be doing that. And I think it's something they need to do to be more efficient. I think the partnerships is really the big thing. I think it's expanding their business to, credit unions, financial advisory companies, and healthcare and things like that will make a big impact on driving revenue up while maintaining their investment management quality. So that's really all we have today. I really appreciate you listening, and everybody have a great holiday break, and it's been a great semester. So we'll talk to you guys soon.